All right, let's take a quick look at the assignment for round 4C. Holy cow, lots of words. Okay, usually that means it's not all that bad. So for the first one, Andrew's investment, in TQM will at a minimum increase demand for its products by 7.69%. So let's scroll down just to show you what we're looking at there. Down here at the TQM, 7.69% demand increase, it says. Okay, so for in this and in all future rounds, so it did it for round 4, but it's also going to be rounds 5 and onwards. So looking at the round 4 Courier for Andrew, last year's sales were a little over 300 million. Assuming similar sales next year, the 7.69% increase in demand will provide $23 million of additional revenue. Okay, I mean, we're just taking this times this, right? 7.69 times that. With the overall contribution margin, 41.9%, you know, assuming that these things are equally applied and whatnot. Okay, after direct costs, so after the variable labor and material, it's going to add 9.7 million roughly to the bottom line. For simplicity, assume that the demand increased 7.69 and the margins will remain at last year's levels. How long will it take to achieve payback on the initial $20 million investment? That's pretty easy math, guys. Okay, rounded to the nearest month. Okay, so I do want you to calculate it per month. Okay, that might take you a little extra math, but not too much. Ignore other savings achieved through TQM and tax consequences or benefits. And I put that in there because obviously if you look at their TQM, they also had material cost reduction, labor cost reduction. Okay, this is demand increase. That's wonderful. Reduction in R&D cycle time, which doesn't really save them money, although it kind of does, right? Because you can move a product further along by spending less on R&D. And then reduction in administrative costs. Well, that's a big percent. Your administrative costs aren't that huge. Okay, but but nevertheless, this is just a pittance really compared to what they would actually save overall. And I say the tax consequences or benefits because while this is an expense, this $20 million is an expense, remember you're in a 35% tax bracket. So the government's paying for 35% of this, or 7 million of it. So your after-tax cost here is actually only 13 million, but I say ignore that. Okay, because you'd be paying taxes on this additional profit at this point in time, and so there's an offset there. 2, in order to sell a product at a profit, the product must be priced higher than the total of what it costs you to build the unit, plus period costs and plus overhead. At the end of last year, product Ebb was sold by Erie. Use the Courier's production analysis. Excuse me a second. I thought I had to sneeze. So use the Courier's production analysis to find Ebb's production cost, labor plus materials. Exclude possible inventory carrying costs, and they didn't have any inventory, so we don't really have to worry about that. Assume period expenses and overhead total half of their production costs. Okay, so after we figure these costs on a per unit basis, then we can take half of that and assume that is our other costs that are involved. Some of our other administrative costs, etc., marketing, whatever the case may be. What's the minimum price the product could have been sold for to cover the unit cost, period expenses, and overhead? Okay, so, oops. Sorry, but if we go, dang it. If we go and take a look at that, and Ebb, right? So we come up here and we take a look at Ebb in terms of the production analysis, which is in here. Here's Ebb. It's a low-end product, and we didn't have any inventory, but there's our cost, so we figure that. Got to calculate then what half of that is for a production cost. You shouldn't need a lot more help on that. I think it's fairly self-explanatory. Okay, 3. Assume Team Digby bought back 50,000 shares of stock last year. If they could. I don't know if they could or not, if they'd be allowed to buy back that much, but the purchase price would have been the market price of the stock at the beginning of the year. So let's go take a look at that. Okay, I don't know if it's given to us. We could either, one, go back and look at last year's closing price, which would be our beginning price, or you can take, here's the close and here's what our change was. So you could calculate what the beginning price was at the start of the year. Okay. It would have been more than that, right? Because we went down. Okay, so assuming they bought 50,000 shares of stock, the purchase price would have been the market price of the stock at the beginning of the year. Had the purchase not affected interest or profit, and we say that because you might have had to borrow money, right? And borrowing money might have affected you might have paid interest, which would have decreased profit, right? So well, let's ignore that, right? And what would the effect have been on, and I want you to show the math on the earnings per share. Okay, well, we've reduced the number of shares, so it should make it go up. Okay, so I partly answered the question for you. And ROE, okay, likewise, we're going to reduce our equity, and so, that should improve. Okay, 4, what will be the total unit demand in the size segment next round? What will be the total production capacity? And I asked that one because we didn't meet demand, right? When we go down and look at that size category, it's towards the bottom here. Look at that. We had 3.9 million roughly in demand, and actual sales were 3.7 million. So we didn't meet demand this last year, and so I kind of want you guys to take a look then and see what we're going to be facing next year. So again, that one shouldn't take a lot of explaining. So there you have the assignment for round 4C. Good luck.